Goodwin, as Gene said, Howard's from Intrinsic Capital, one of the leading early growth and growth capital investors in cannabis. I think you're about to raise your third fund. Have you announced your third fund? Second fund. Okay, I'm sure you're going to tell us more about that. And also looks like he's just fresh from the weight room, from the bench press bar, but that's okay. And Jack Mascone, as Gene said, who is the head of capital markets at Seaport Global. Jack is going to sing for us today also, by the way. But Seaport Global, so when we tell the ArcView story, we tell that, from 2010 to 2019, at over 50 ArcView conferences, some $350 million of equity capital was raised for over 250 companies. And I would say probably through that period of time, that was the majority of the equity financing in sort of that early stage of this industry. But Seaport's done an amazing job. Jack, I think you guys have placed close to, I think from your website, look like $1.3 billion even since that time, since the pandemic. So yeah. Great job. So look, let's do this. Let's start with you, Howard. Let's allow you to give a proper introduction of you and your firm, and maybe talk a little bit about what drew you to this industry.
Great. Well, Jeff, thanks a lot for hosting. Gary, thanks for inviting us. Appreciate it. Great event today. So just in terms of my background, and I'll be brief on that, but out of Princeton, I got a medical degree at Jefferson in Philadelphia. And instead of practicing medicine about 20 years ago, I got into life science investing. Was fortunate to work at some great firms like Maverick Capital, Citadel, and Millennium. What we were drawn to in terms of setting up a growth equity fund to invest in this space was from a healthcare perspective, because that's sort of my background, we became big believers in big disease areas like chronic pain and a lot of the disease categories that fall under the broader umbrella of inflammation. And once we kind of drilled down on the data that had been generated in other countries where it was easier to do the medical research, we concluded that this could be a whole new therapeutic category. We're big believers long term in the health attributes of this market. And then beyond that, as we started to really drill down on the industry, actually going to events like ArcView, where we were able to really just study the different companies that were emerging in this very high growth industry, we realized that they're both on the life science side and on the technology side. There were a lot of businesses emerging that crossed over with our operating network. And Intrinsic at its core is a very active investment group. We get very involved in the companies we invest behind as needed to help the companies scale. So we're not overly in the business of our co-founders and CEOs and so forth, but we just try to supplement and figure out where the gaps are and just help those companies to be successful. And so, we've deployed our first fund. Our IRR is over 40%. So we feel, great about, just the strategy, and we love the growth in this space. Obviously, it's a challenging space as well. So there are a lot of pitfalls, but we're big believers in the operating network.
So before I ask Jack the same question, would you like to just highlight one or two of the deals that you've done?
Sure. So our first investment, ACT Labs, it's a lab testing business. What we like about that part of the supply chain, it's a bottleneck in a lot of these states where there are not nearly enough labs relative to the number of producers that are out there. Very high margin business, recurring revenue. And it, as I mentioned earlier, it crossed over with the background of our operating network. Cornelius Merlini, one of my partners, his last operating role was running a national lab business. So we know the blueprint in terms of how to scale that type of company, and that's an example of the type of businesses we invest behind.
All right, Jack, now your turn, but don't sing, okay?
I won't sing. So as Jeff and Gene mentioned, I am the head of capital markets at Seaport Global, which is a 350-person investment bank. We are essentially a global investment bank now, broker-dealer operation, headquartered in New York, offices throughout the United States, London, Dubai. Australia. So we're 350 people, so we're probably more properly characterized as a big little firm. And we've been involved in cannabis really since the latter half of 2019 into 2020, and we like a lot of investment banks have had to navigate the real cross current between being a regulated entity in the financial services industry and trying to find ways to advise and help raise capital for these companies that are simultaneously operating in an industry where it's federally illegal, yet they are legal in the states within their operating jurisdiction. So it creates a host of consideration and risks, particularly if you have a banking oversight element to your investment bank. So we've been able to, because we're not quite at that level of balance sheet, we've been able to get comfortable with outside counsel that we can in fact service the industry. And so since then, as you alluded to, we've been fortunate enough to help advise and lead manage, either in an underwriting component or in private placement, over $1.4 billion in cannabis debt, and over $1.65 billion when you add cannabis equity, cannabis company equity, sort of the service providers to the cannabis industry, in particular the finance providers, and then as well on the private side, where we've raised both debt and private equity for a number of different companies.
Your role in the industry is incredibly important right now. So we all thank you for being here and doing what you're doing. The Viridian Capital Deal Tracker, I think the last one I read was about 2 weeks ago, said that capital raises are down about 63% year to date. We've noticed, because we're investors more at seed and early growth, that's been a real gap of capital at seed, just a crazy imbalance. And now we're seeing it, I think, all the way up and down the cap stack. So Howard, for you, I mean, is it a buyer's market?
I think so, but different companies are some are good, some are bad, and so what we've seen is indiscriminate selling across all different types of businesses, which generally presents opportunity. But what we tend to focus on when we're looking at a given business: barriers to entry, high margin companies, recurring revenue, where we can through the operating network really be involved and kind of line up on a path to success. There are companies out there that may be cheap in terms of their valuations right now, and they may get cheaper because they are either selling a commodity, they're not scalable, they're very capital intensive, et cetera. Not all companies are created equal.
So good companies, good performers, companies with the right metrics should be able to raise money, but I get the sense that a lot of good companies are not able to raise capital because of this gap that's missing, particularly at early growth.
Yeah.
So once you sort of emerge from seed and you're operationalizing the business, you need that first $10 million to really sort of turn a product or an idea or the beginnings of a license into a business. They're having a hard time.
Yeah, and I mean we tend to really be that first $10 to $15 million slug of capital. So we tend to lead the deals that or the rounds that we invest behind. And yet we've got a number of colleagues in the industry who are at other investment shops where we all kind of line up on what the path to success is. So a lot of great investors out there. It's just, to your point, there aren't a lot of folks who can lead a deal right now in that $20 to $30 million round, and so it's I do think it does translate to it being a buyer's market.
So all the good ones are coming to you.
Well, not all of them, but
Jack, is it harder to get larger debt issuance placed now than it was, let's say, 9 months ago?
Yeah, so first of all, I think it's important to keep in mind where we are on a macro basis. We're several hundred basis points higher in the risk-free yield via the Treasury market, for a variety of economic factors that we don't have to talk about here, the general U.S. credit market is significantly lower than it was year on year. So that's a backdrop. And then when you overlay what I'll call the dislocation between what happens in the cannabis equity market and what happens particularly with the larger cannabis borrowers, there is a little bit of a disconnect. So what I would tell you is, in general, borrowing rates for high yield companies, which most U.S. cannabis multi-state operator companies, public or private, would be perceived as equivalent high yield issuers, are generically up 300 to 400 basis points. And when you look at that spread, the cannabis company cost of debt capital is not significantly wider than that. It is a little bit, but not significantly, maybe 400 to 500 basis points. So it's expensive, but what we're really seeing is discrimination, not so much because of the company's fundamentals, but so many investors came into this market early, not only based on sort of the attractive risk-adjusted returns that were available, but also sort of the catalysts that were industry-wide that haven't come to fruition. So, legalization is the big one, but obviously that's not on anybody's near-term radar screen. But giving some sense of relief from federal prosecution via SAFE Act or something. Everybody talks about uplisting to the U.S. exchanges and everything, but the real effect of that from a return on capital perspective it'll lower the barriers to entry for new investor participants to come into the market. When we do a $350 or $450 million deal for Curaleaf, we've got 35 investors, 30 of whom are institutional type participants. But there should be 100 or 200. And the biggest names that you see on TV on the commercial when the golf is on, they don't invest because there's just too much business and legal risk for them to put their investment process through that. And until that happens, you have these significant barriers to entry. And I think it's compounded by the fact that there were significant expectations going back to early 21 that this was going to be addressed. And since it hasn't been, you had a lot of early investment on that basis alone, and now it's not only not come to fruition, but they've lost some money. And so there isn't that next big pool of capital. So it's a tricky dynamic. But for the better companies with the right business models and the right management teams, they still have access to debt capital, and they still have access to equity capital. Of course, the flip side of that, particularly on the equity side, is they're not as keen to use their stock either as currency for raising new cash or even in the acquisition process.
So, you mentioned 35 institutional investors that, are interested in looking at what you're representing. What kinds of institutions have made the decision to invest? I mean, certainly pension funds, traditional institutional debt funds that might have vice clauses, depending on their LP base, can't do it because it's federally illegal. But what are the types? I'm not asking you for names. I'm just asking for the types that are taking the early risk.
Yeah, so no, it really does cut across a decent spectrum. So first of all, the family office community, if you will, from 5 years ago to where it is now is a lot more institutional-like. They've become much more professional. They have a lot of significant wealth has been accumulated. They have a lot more purchasing power. And, again, without boring everyone to tears further, the risk-adjusted return in the cannabis sector for a lender in particular is very attractive. So family offices are a big player, have been, and continue to be. Probably the evolution comes from U.S. hedge fund participation. There are some traditional investment managers that have essentially carved out forms of capital in portfolios or in charters where they are explicitly permitted to invest in, plant-touching businesses. So that is really the significant change over the last few years. The other thing I would say is particularly in the U.S. equity investment community and some of the bigger deals we've done, they have looked at these 9, 10, 11, 12% yields and said, wow, we love these companies. We wouldn't mind at all going up in the capital structure and clipping a nice income for the next 3 or 4 years because we believe that they're going to be the winners in their sector and we're going to get refinanced. So it's all of that. I can just tell you anecdotally, we've done 2 deals for Curaleaf. I mentioned that because a lot of people have heard of Curaleaf. It's a big national MSO. When we did the first deal in the end of 2020, I think we had about 22 investors on a $320 million deals. There were maybe 5 hedge funds and investment managers. Now, 2 years hence, we closed a deal in last December, which was a refinancing of that first deal, and 30 of the 35 were the sort of not the family office, high net worth community. So big evolution.
Yeah, for sure.
And I would just say, as far as our LP base for the prior fund relative to as we go out and raise the next fund, you are seeing more institutional appetite. So it's not just family offices and we expect that to continue to evolve. Now, granted, the types of companies that we're investing behind are federally legal, so they're not the producers and the dispensaries, but they're more ancillary type businesses.
So you're not doing any plant touching.
Well, no. So we have a wellness company where all the products are hemp derived, and that business is run by former McNeil executives from Johnson & Johnson. And then we invested in BRC, which has one of a couple of DEA licenses. And so they are legally, from a federal perspective, allowed to produce the plant. And that API, or active pharmaceutical ingredient, is used by academic institutions and pharmaceutical companies who are going down the FDA track.
And that certainly changes sort of the opportunity for you to put together your next fund, right? So you don't sort of fall into that area of operating a federally illegal business.
Right.
So, what I've noticed, this same thing happened in 2019. Public cannabis companies dropped 90%. All of the companies at seed and early growth had just ridiculous valuation expectations. And it took a while for that to rationalize. What about now? Have you seen issuers' valuation expectations still in the stratosphere, or have they rationalized? Or does the market have to slap them first?
No, so I think it's a little more complicated than that, because when you look at the valuation expectations, particularly some of the larger public companies, they see so many acquisition opportunities. So even though their equity valuation multiple is very depressed, they can buy things at even more, they can do accretive transactions even at these low share prices. And part of the operating challenge, or the challenge in running a really aggressive cannabis company, is finding that balance between building and expanding and exploiting opportunity, and then realizing profit and getting away from that heavy expansion. But so I think it's what I've seen in direct dialogue, and we have a number of M&A mandates currently, and we talk to a bunch of companies, is it's not as simple as, oh, our stock is way too cheap. It's a lot more having to do with, why is it divorced from some pretty serious fundamentals, and is that going to change? And in the interim, does our stock, particularly with respect to M&A, is it a very effective currency for bolt-on acquisitions that will make the enterprise much more valuable in the long run? So that's where I think the better companies are focused. Not so much in a vacuum, my stock's too cheap, but how can I use it to exploit my capital advantage? Because for every big company with a public listing, there's a lot of private companies that don't have the same access to capital.
Yeah, understood. How about you, Howard?
Yeah, we have seen, teams that are going out and raising money who maybe a year ago thought their valuation was X, and now it's half of X in a lot of situations, particularly in the technology space. And all you got to do is look at the public comps, and at a certain point, they got to sort of give up on thinking that their company's worth, 40 times sales and kind of come back to earth a little bit. So.
Okay. I've actually been given the 5-minute warning. Jack, you said this was going to go fast, and it has. All right, let me just get in a couple of macro questions, okay? Just had to write this stuff down. The American Cannabis Stock Index down 60% since this time last year, and it's already rebounded 20% from the low. Top 10 large cap U.S. operators trading at 9.6 times EBITDA versus 12 to 13 a year ago. Yet the industry expected to grow 28% this year. Q2, many of the larger, more well-known operators reported growth. Verano up 12%, Planet 13, 11, Ascend 15, Tilt 9, Columbia Care 5. And for the year, many of these majors are up 8%, even as high as 90%. And most of us probably in this room still think, or this facility, still think that this is a generational wealth creation opportunity. So what's going on? Why the gap? What is it going to take to move equity markets to where they should be? Or are they where they should be? Is it operator performance, or is it sort of demonstrable progress on the regulatory side? What's it going to take? What's the catalyst?
Well, so it's a little bit of both, but all these companies and all these multiples, there aren't very many free cash flow positive companies. So if you think about what an equity
280
is,
takes a bite.
Well, exactly. So it's more about, can they operate profitably today, or is it more intelligent to gain share because the rules have to change because the industry can't exist without it, and it's really tricky. But I personally believe the near-term catalyst will be on the regulatory side. The operators are in a tight spot with respect to 280E and state-by-state regulatory paradigms that have very little in line with each other. So managing that across a multi-state operator portfolio of businesses is very hard. I think over time, you'll have to see consolidation. I don't think that's a controversial statement. But in the near term, I think the most obvious catalyst is regulatory relief. And I think it was Len Tannenbaum that was talking about SAFE Act in the lame duck session of Congress. I agree with the general view that if something doesn't happen then, it'll be challenging, even with all the good operating statistics that you highlighted.
Yeah, no, I totally agree that regulatory is going to have to be the catalyst to kind of break the MSO stocks out from where they're at presently. But I would just say that on the ancillary side where we're focused, that growth that you mentioned is still very much there. The industry is projected to grow 25% or so this year, which you can't find in a lot of other markets, particularly in a down economy. And so we love these companies that do have high barriers to entry, recurring revenue, and they're supporting the industry. They're connected to that growth, and they've got very, very strong business models and good management teams. So we think there's a lot of opportunity, in the coming years because of that growth that really is not connected to macroeconomic trends.
So with 1 minute left, final question. Will SAFE or SAFE Plus be enough of a vehicle to change that trajectory? Since we're down to about 30 seconds, that can be a yes or no from either of you.
I think it'll be a catalyst for share prices and for general valuations to go up, but in and of itself, it's not the answer. It's not even close.
Agree.
All right. Thank you very much, guys. Thank you.
Thank you, Jeff.